You're watching Find Better Stocks, and this is the first episode in a weekly series where I'll be doing a deep dive into a stock that looks like a potentially fantastic investment. So let's start it off with this week's stock. It's a huge company this week. Let's kick off with a big one. It's AT&T, the world's largest telecommunications company and the second largest provider of mobile phone services in the US. This company is ancient. It was founded in 1885 by none other than Alexander Graham Bell. So let's take a look at some of the financials. We're going to nip over to the Better Stocks dashboard. There's a link down in the description below if you want to check it out. So first off, we're looking on the 11th of December 2018. The share price at 30.14. We can see it's got a huge market cap, absolutely huge, almost $200 billion there. That's a good sign. If you want to be defensive about your investments, this is a rock solid, steady company. So let's have a look at this blue box here, the value indicators. First of all, there's the PE ratio. It's standing really low right now at 5.7. That's a price to earnings of 5.7. The price to book ratio is at 1.2. As a value investor, it's always really nice to see a price to book ratio under 1 if the business is of course good, but 1.2 is a pretty good number to see. Dividend yield really high. It's consistently high with AT&T, and that continues to be the case and will continue to be the case in the future, no doubt. Overall, we can see that this gives AT&T a really nice value rating of 8.7 out of 10. So let's go over to the yellow box now. We're going to look at the growth rates. We can see revenue at 5.8%, net profit at 43.2%, and equity at a small decrease of 0.6%. So these are taken over the last 5 years, but it's always more interesting, I think, to look at the actual graphs. So if we just go down here, let's take a look at these charts. So revenue, we can see the reality is it's been steadily increasing, slight decrease from 2016 to 2017, and here we can see that the trailing 12-month figure is actually back on the up again. It's back on the up even from 2016, and it's certainly up from 2017. That's a good sign overall. It's a good trend. If we go over to the net profit, we can see a similar pattern. It has actually had a trend of increasing over time, and the trailing 12-month figure is looking pretty nice. There's a bit more good news when we look at the equity. We can see that the equity is very steadily increasing, and the trailing 12-month figure is the largest that we've seen for the past 5 years. Again, that's obviously replicated in total debt, which has slowly been decreasing as equity has been increasing as a percentage of the total assets. So overall, those are good charts, good signs. Everything that should be going up is going up, and what should be going down is going down. So that's what we like to see. So let's nip over to the strength category. This is where we look at the underlying core strength of a business. Business is there to make money. We need to keep that in mind. So let's look at the return on equity. It's at 22.3%. That's a nice strong figure. The profit margin is at 18.3%. That's a good figure as well. It's not super strong. There's other big companies with a stronger one. One right now is Kraft Heinz that has a huge profit margin. I think it's around 40%. That's a bit of a standout figure. I'd just like to mention Kraft Heinz because I think that's a fantastic investment at the moment, but 18.3% is certainly very strong. We can see that the debt to equity ratio is at 1.9. This is a little bit higher than I would like, to be honest. I'd like to see it come down from this, but what does give me confidence in this figure is this chart down here. As we've already seen, the total debt has been decreasing year on year, so it's clearly something that they are addressing. This is total debt as a percentage of total assets, of course, and it is at the lowest point of the trailing 12 months that it has been for the last 5 years. So they are decreasing their debt to equity. So although this is high at the moment, we would expect to see perhaps a decrease in this in the future, and overall it does really strongly in strength. Overall strength rating of 8 out of 10, performing very well. And we can see how this translates into the overall rating for the stock, 7.7 out of 10. That's how it's got onto the Better Stocks index, and that's how it's got into the Find Better Stocks dashboard. A strong 7.7 out of 10 indicates it's probably a good investment if everything else, of course, looks attractive to us. So let's look at some of those other things. First of all, this dividend, is that usual? let's look at the history. We can see it pays out quarterly, and we can see here all the dates going back to 2011. So what we can see is it is extremely steady. It's very, very, very steady. What we can also see, which is quite interesting, is that it generally increases by about 2% every year. You can see here 2.3%, 2.2%, 2.2%, going up to 2% increase in the latest one, the latest expected one. And this is a good sign. Not huge amounts of dividend growth. Don't expect the dividend to grow massively. This is generally in line with inflation, but it's a steady dividend payer. It's a safe dividend bet. And what we're particularly interested in anyway at the moment with this stock is the fact that it does look very undervalued. So with that value in mind, let's nip over to the share price. Now, share price is one of the things, or share price history is one of the things that doesn't interest me a great deal when I'm trying to find a stock. It's one of the last things that I look at, to be honest, because it doesn't really matter where a stock's been in a way, and you should never, in my opinion, look at a chart to try and understand if it's going to bounce back. You need to look at the financial fundamentals to see that. But what we can see here is that for the last 5 years, it's never really been at a lower stage than it is right now. It's dropped around 30% from its peak back in 2016, and to me this looks attractive again through the eyes of a value investor. But it's not just my opinion that counts. It's always worth looking at the analyst reports. They are of course experts in their field, and it's always nice to try and validate your opinion with the analyst reports. Don't always try and fight analyst reports. Don't try and go against the grain all the time, especially companies like AT&T. You want to see what they're saying. So let's take a look. Recommendation overall, as you can see here, is just going into the buy territory. And you can see most analysts are saying hold, and then there's a good group saying buy and a good group saying strong buy. I think this looks pretty reasonable. I think this backs up the evidence that we've seen so far that this is a potentially good investment, a safe investment that has some room to grow. We can see down here that the target average is around 34.4. That allows for perhaps a 10% or so, 10 to 12% increase on the current position. When you add on to that a nice dividend of around 5-6%, you're looking at a potentially really nice and quite safe investment. So let's just finish off by taking a look at those financials again. This is what we like, this value category, absolutely smashing it with an 8.7 out of 10. The growth is a bit lower, 6.3 out of 10, but we can see from the charts that it's doing very well, an overall trend. And of course, the core financials of the company and how strong it is, how much cash it can actually generate, is strong, it's looking good, the debt's coming down. I think this is a really good company for a safe investment, for someone who wants to be able to put their money away into a company that they can expect to grow from this point. I think the share price will rise, and you've got the comfort of knowing that you're definitely going to receive quite a nice dividend yield. AT&T is my showcase stock this week. Join me next time where we're going to be taking a look and a deep dive into another fantastic investment. Catch you again at Fine Bet Stocks.